Well, good morning. This is Dean Tenney. I'm coming to you from my studio in fabulous Las Vegas. We've been trying to finish up this explication for you Series 65 test takers. So the goal today, as you can see here, where we left off last time on these explications, remember, these are not lectures. These are, intellectual inventories. I highly recommend you go to the NASA, Google NASA Series 65 and print the PDF, and you can take notes, follow along, and use it in your study effort as an intellectual inventory. Anyways, in the last installment, we left off on options. I appreciate your positive comments on that. Real challenge. I felt like I was kind of rambling a little bit, but what you going to do, right? Some of this, that's the challenge on 65, 2Z, 3Zs. As you can see here today, we got two questions, alternative investments. A lot of these are higher probability than others, and only two questions on insurance products. So be careful. I mean, when I'm teaching a class, a 65 class, if they're life insurance professionals, I just skip the entire thing because, they probably know it. And those are not life insurance folks can, guess B perhaps and do that. And we know which ones are high probability there. So we'll talk about that. And we got two questions on other assets. If I can finish this up today, that would leave us setting the stage for another major topic, as you can see here, 39 questions on client investment recommendations and strategies. So that is the game plan in this installment. So let's get started. So if we're one of the investment vehicles, alternative investments certainly have heightened suitability. The way I think of it is our other investment vehicles are tried and true. We know how they work in different environments. Some of these, perhaps other ones, not as tried and true. Partnerships certainly are. But partnerships, our clients, if they become limited partners, are going to only be admitted or emitted. Emitted means leaves the partnership. You can only get in plain English. What that means is get in or out with the permission of the general partner. And that's important because if you can only get in or out, permission of the general partner. And what that means in legal terms is that in a partnership, you do not have a freely transferable interest. Like in stocks, if you're on you can sell your stock anytime you want. And so that means the test issue is, as an investment advisor representative, you should know that partnerships are illiquid. They have no liquidity. Illiquid. That just means, you can't get in or out without the permission. So that should be money that, your client can afford to have in there for a long time. Separate issue. They have a finite life. Exchange rate notes are very high probability on your exam, very high probability. And the key word is note. And so very high probability. This is a debt instrument. Let me get my red again. If you've been following around in the explications, red is to distinguish what are my comments from what are NASA's test specifications. The debt instrument. So you have credit risk. I think the easiest contrasting point here would be with a exchange traded fund. An exchange traded fund actually owns the underlying assets. They have a relationship with a custodian like State Street, and State Street Bank and Trust is holding the monies and securities of the exchange traded fund. And that's a lot of logistical problems, and it's expense, added expenses. And so maybe a financial institution or sponsor says, I want to have a product that's similar to an ETF, but I don't want to actually have to physically own those assets and custody them and, do all that kind of stuff. So one thing I could do as a financial institution or sponsor or underwriter is issue exchange traded notes, where I say to the holder, it's linked to some kind of an index or whatever it is. And I say, this exchange traded note at the end of 5 years or 10 years, if the Dow, I'll pick the S&P, that's a better version. If the Dow goes up 36%, if you have bought this for 100,000, we owe you $136,000. And so now the problem with that, I mean, I would have no problem if the, contraparty to this was, JP Morgan or, Merrill Lynch or, somebody I've heard of, but, if it's somebody I haven't heard of, that's a problem. So you have credit risk, the risk of default that the sponsor, may not pay you the promised return in the exchange order. I would suggest too that, all the legal documentation is done by the sponsor or underwriter or distributor of the exchange traded note. And then that means, it's in their favor. And I've seen some of these like close early if they can't figure it out. So leverage fund is trying to deliver a higher return. And they do that by using futures. And so maybe it's, 2x. By the way, what's going on here, these are trading vehicles. Most of these, like ETFs and ETNs, they're not long-term investment vehicles for a client's portfolio. So, they're more short-term trading kind of vehicles. Anyways, we try and do the 2x or 3x and of those funds, and you make money twice as fast, you lose money twice as fast. And they're using futures, which means they have to keep resetting these things. Again, exchange traded notes, high probability, leverage funds, low probability in terms of your exam. Inverse funds try and provide negative correlation. What they mean by that is they attempt to go the other direction. Again, shorting futures or using futures. And again, they have the problem with this reset, trying to get this thing right. These leverage funds a lot of times don't actually do the 2x or 3x because of the things. And these have imploded in the past as well. And this one is also low probability. What is very high probability is this idea of negative correlation, things that go opposite directions. And I think we talked about that earlier in analytical tools. It looks like I went a little too far there. All these structured products, all these newfangled kind of products, the test question is all these structured products. We have men and women who work in structured finance, and they're the ones who dream up these things. And in all these, as I mentioned, there's heightened suitability about whether or not somebody, should be in an ETN or a leveraged fund or an inverse fund. If they don't understand it, I mean, that's going to be a problem. But even more importantly, if you, the investment advisor representative, don't understand it, that's even a bigger issue, right? So if you're going to get people involved or put this in a client's portfolio, you definitely have, the obligation to understand it. Viatical life settlements is where people sell life insurance, their life insurance. And the idea is, you need the money now. And so you'll sell your life insurance, people will package them up and then sell them as a, vehicle saying, okay, when these people die on the actual tables, there'll be a payout of some sort if you're in our, viatical fund. Very low probability. I have not seen, got any reports back that people have had question on the viatical life settlements. Please pay attention. I told you insurance-based products are only 2 questions. Wow. And so be careful. I mean, this could, I told you that last installment on options. I mean, at least that was 5 or 6 questions. So, if you're going to go down some kind of a rabbit hole, make sure it's worth it, in terms of performance opportunities. In a fixed annuity, that is a non-securities product. On your exam, when we say non-securities product, we mean insurance. And, sometimes they'll say insurance, sometimes they'll say non-securities product. And a fixed annuity, when I do a fixed annuity, I give you an example. I give the insurance company $1 million, and they agree to turn that into an income stream to me. That's kind of cool. And my insurance professional says, well, Dean, I say, hey, how are they going to do that? They said, well, Dean, they're going to take your $1 million and they're going to put it in the general account of the insurance company. They're going to make investments. General account, they're going to buy stocks and bonds and real estate, and they're going to hope, Dean, as an insurance company, we're going to hope to make more than we've promised you. But at the end of the day, the investment risk is assumed by the insurance company. And, they won't be an insurance company long if they can't do that. Now, that means the person who owns the fixed annuity does not have investment risk. So that's kind of the point in this fixed annuity. All fixed income investment vehicles, including, fixed annuities, have inflation or purchasing power risk. What we mean by that is that, that payment that you're getting, it sounds good until, inflation, erodes it and you can buy less with the dollars you're getting. No, in a variable annuity, you're taking after-tax money. Sometimes we refer to this after-tax money. When you have a type of a retirement plan where you're using after-tax money, the word for that is non-qualified. And what we mean by that is you're using money that you've already paid taxes on. Qualified would mean you've met the qualifications to use pre-tax money to make the investment. You'd have a zero cost base. So non-qualified means you're putting money into this variable annuity that you've already paid taxes on. And so your original contribution in the variable annuity, let's put it this way, contributions are your tax base. Your cost base. I usually use the example of, a young professional athlete, perhaps, let's say they're 28, 29, they've maxed out all their other retirement plans and they still want to put some aside some money. I said, well, why don't we take a $1 million after tax and buy you a variable annuity? Now, in a variable annuity, very important, the investment risk is assumed by the annuitant. Now, what we mean by this is, you see, I figured out what you guys have been doing, you insurance company. You've been taking all my money and making these investments and making way more than I promised you. I don't think we've misled you about that. I say, well, listen, if you'd like, in a variable annuity, we'll take your money instead of putting it in the separate account, or the general account, we'll put it in the separate account. Sometimes we call people in the insurance business the annuitant. So, the investor. And so the money's, the contributions are being placed in sometimes on the test, they refer to this as in a separate account. That just means, by the way, a mutual fund. So you pick one of these mutual funds and you hope that it grows to. Sometimes on the test, they refer to this as a sub account. And, again, if you're, let's say the professional athlete is 29 and a half, they give me $1 million after tax, and now they're 59 and a half. Again, like any other type of retirement plan, there's a 10% penalty, if you withdraw these funds before 59 and a half. And, now you're 59 and a half and there's $10 million in there. So over the 30 years, the separate account, the mutual fund, remember, you assume the investment risk here. It looks like you've got a good return. And now there's $10 million in there 30 years from today. And there's a lot of things you can do with that. You can say, Dean, send me a lump sum. That means send you the $10 million. You can do a random withdrawal of the money. You can do a annuitize, turn it into an income stream that you can't outlive, which is kind of cool. Those are your choices here in this annuity. And, lump sum or random withdrawal, a lump sum in my example, we have 10 million, you're going to get $9 million and it's going to be taxed at ordinary income. And he said, gee, you didn't tell me. I go, oh, that's bad. Withdrawals are taxed at your ordinary income tax rate. And that's not so good because, if you had put this, for example, in an index fund, you'd have a long-term capital gain. Anyway, so it's taxed at your ordinary income tax rate when you do that lump sum. Random withdrawal, you say, hey, Dean, send me the $1 million I originally put in there. And that would be LIFO. I say, no. If I send you $1 million, it's going to be the $1 million of the $9 million that you haven't paid taxes on. So if you're doing a random withdrawal, that's going to be LIFO. Last money's in, first money's out. When you're struggling on tax questions, just guess whatever yields the most for the US Treasury, right? So again, you can see we're filling up the screen here for, a couple of questions. So again, don't overdose on this. And annuitize means turning into an income stream, and that's kind of cool. And you have lots of choices there. You can choose, life only, life with 10-year period certain, joint and last survivor, but life only gives you the largest monthly check. Okay, so equity index is very high probability, very high probability. An equity index annuity, we said there's two, and I told you there's a couple that are high probability. So we actually, I'm not so sure I wouldn't just, take the two I'm telling you high probability and guess beyond the rest. The main thing people get hung up on this equity indexed annuity idea is, again, not a securities product because you can't lose your principal. And what I mean by that is, if it's like a 80% participation rate and it's an equity indexed annuity and the market returns, I don't know, let's say 10%. 80% participation means I'm going to get 8%. Again, this isn't a lecture, it's an explication. That being said, though, what's kind of cool about the equity index annuity is there's never going to be a negative reset. And that means you're never going backwards. So in this example, right, let's say the market goes down, we get our 8%. So now my equity indexed annuity was 100 grand. Now it's 108, 8% or 80% participation on the 10% return of the S&P 500. I'm just making that up. And so now the market goes down 20, we'll reset the next year at 108. So there's no negative reset. So I'll leave it to you in practice problems. I have a couple in the practice final that illustrate that for you, but make sure you understand you can't go backwards in that equity indexed annuity. Okay, let's see. We got two questions in this category. Okay, so I told you the highest probability there is going to be equity indexed. That's going to be your main one in that area. Life insurance. So one thing that's, again, there's only two questions in this area. And one of the things that, they ask you about is, look at our different color here. Is a capital needs analysis. When we're doing a capital needs analysis, what we're estimating is how much life insurance you might need. Now, listen, I joke, I'm not an insurance guy, but insurance agents sell fear and stockbrokers sell greed. Life insurance agents say, wouldn't life be terrible if, and stockbrokers say, wouldn't life be wonderful if? So if you're duly registered, you can sell both. But if I'm talking about life insurance, it means you really, need life insurance because that's not my thing. But anyways, a friend of mine, Jim, said, Dean, I don't like to make a bet with an insurance company that I have to die to collect. And I said, well, Jim, you're missing the point. It isn't about you. It's about your wife and your kids and, how to replace your income and the investment program that won't be completed if you're not here. And, that's kind of what this is about. It's not really about, the person who is going to check out. It's more about the people they're going to leave behind, right? So that's testable, this capital needs analysis, how much life insurance coverage we need. It shows up on the exam. And then the other thing is, you're never supposed to sell life insurance as an investment. So, whole life and term are just traditional insurance policies. And you shouldn't be, holding that out as some kind of a, investment opportunity. By the way, that's true of the rest of them as well, right? Now, in universal and variable life, I talked about this concept of, the general account and the separate account. And in variable life, my premiums, some of my premiums are going to go into the general account for those things are insurance oriented, and the some of the money that I'm paying in the premium is going to go into one of those separate accounts again. Remember, that separate account or sub account is a mutual fund. And, what you're hoping is that mutual fund at some point or separate account would grow far enough that it could support the cost of the insurance. And so that's the general idea in variable life. And here you have a fixed premium, just like, what you're going to pay. To be honest with you, every time I heard like variable annuity or something, I'd say, mutual fund with insurance wrapper, because that's kind of what's going on. Okay, and then the other version of this we have what's called universal life. And here, none of the money is actually going into the general account. It's all going into the separate account. And that means that, if you don't make these, you got flexible premium. If you don't pay, they're just going to take that money out of the separate account for the premium that you didn't pay. The point is, if you, keep not paying, you have the flexible premium, they keep dipping into the separate account. At some point, the life insurance may lapse. So of these two questions that you get, the high risk ones again, or the equity indexed annuity and the capital needs analysis, those would be the high probability ones for you on your exam. Other assets, two questions here. So investment real estate, if we're buying real estate, what we're trying to is get different returns than we're going to get from our financial assets. Remember, what we're in these other assets, both of these, by the way, other assets, let's put that there. We're trying to get non-correlated returns, returns that are different. But with my, rest of my financial assets. I wouldn't go so far as this is negative correlation, but non-correlation, meaning they don't move together. They have different, returns. And so that's why we would want to perhaps put some investment real estate into the client's portfolio. And commodities and precious metals would not only be, a good non-correlated return perhaps, but also might be a nice inflation hedge. A hedge means offset risk. And commodities and precious metals. Now, it's stupid but testable. Make sure that copper is not a precious metal. Sometimes they'll say, all the following are precious metals except, gold is. Copper is an everyday metal that we use in lots of things. In fact, a lot of people, call copper Dr. Copper because it can, has a good, gold, silver, titanium. Those are precious metals. Copper is not a precious metal. Okay, so we've talked about a total here. Let me just go through and review. We've talked 2 questions on other assets. We've talked 2 questions on insurance, and we've talked 2 questions on alternative investments for a total of 6 questions. And this an explication of this section of the 65 NASA test specifications. We talked about partnerships and the potential test question there. We said exchange traded notes. Let me just get out my annotation tool here just to be clear, what I think you are more likely going to encounter. And so let's do it this way. Boom. So exchange traded notes. I can't imagine a draw in which you're not going to get asked about exchange traded notes. Whoop. I'm trying to move up my screen. It won't let me move my screen. There we go. We said, equity index annuities. There's another one we said that is very, high probability. Capital needs analysis, maybe 50-50. Sometimes people tell me they see it. Sometimes people, don't. And then copper, high probability not being a precious metal. They love the accept format. All the following are precious metals except. All right. Well, again, like, share, subscribe. I don't mind, doing the 65 playlist. It's the least viewed of our playlist. So do me a favor, make sure you share it with other 65 test takers. I'd like to get the viewership up. I'd like to think that this is a productive enterprise. Right? So like, share, subscribe. And like I say, the next installment, I made finishing off this 65 a priority. So I'll continue to make some installments. And what I'm going to do is, try and get better at, finishing something rather than having a bunch of stuff running around on the channel. So the goal is finish 65, then finish 66. I told you this would be a lot easier because these are the same content on 66 to try and do something that works for both. But I'm trying to keep, so you've hit the 65 playlist, you're getting 65 stuff, and the 66 is separate. So that's kind of my goal. All right. Like I say, like, share, and subscribe, and I'll see you for the next installment.